Can you?
Good morning.
You are. A little bit later than billed, but thanks very much for waiting. So we talked to you last July about Alliance Trust. So really, I think what we're looking for is a kind of update, but maybe it's worth recapping anybody who wasn't listening then, a little bit about what the fund's trying to achieve and what your role is within it, please.
Yeah, absolutely. Well, good morning, everyone. Yes, so just as a reminder, I chair the investment committee at Alliance Trust, and it's Willis Towers Watson that run the trust and have done since April 2017. So going on 4.5 years now since we took over. And when we came in, it was moved to a completely equity investment trust, global equity investment trust, with a benchmark of the MSCI All Country World Index, and it was put into a multi-manager structure. But the idea was to have a multi-manager structure that was a bit different to the others that are out there and had some real advantages. So firstly, an ability to get access to managers that you don't typically have the ability to get access to in the UK retail space. And so a number of the managers that are in the lineup are known more in the institutional space, or indeed if they are known in retail space, often outside of the UK. So that's the first point. The second is that they were each asked to run highly concentrated portfolios. And so some of the issues with traditional multi-manager approaches are that you can end up with a overly diversified portfolio that then is going to struggle to beat the benchmark and produce strong outperformance over the long term. This is a different approach where each manager is asked just to give us their best 10 to 20 stock ideas anywhere globally. And we ask the managers to think about risk in terms of permanent loss of capital rather than short-term risk relative to a benchmark or a peer group. And then we worry about how we blend those managers with different styles such that we can think about the risk relative to the benchmark from how we manage the weightings to the managers over time, and just get their very best ideas so that every stock that's in the portfolio is someone's top 20 idea. That's the principle behind it. The other problem typically with multi-manager is that it can end up quite expensive with the multiple layer of fees. And the big advantage here is that because we at Willis Towers Watson advise on about $3 trillion of assets and have discretionary capital of about $180 billion of assets, we're able to negotiate much lower fees with the underlying managers than is the case elsewhere. So despite the fact that they're running higher, more concentrated portfolios for us with expected outperformance being higher, we can get that at a lower fee. And so we've managed to keep the OCR on this portfolio in about the 0.65% range with no performance fees or anything like that on top of that, and so way lower than other multi-manager funds and lower than many single manager funds. I think the other thing to note here is that it really has got an advantage over others in terms of the strength that it's got from its approach to ESG. And so that's very much integrated into the whole process here, and in particular around climate, and that might be something that we get to later in the questions. Looking for the genuinely innovative growth companies that are out there. So industries going through structural change that provide long-term ways of getting structural growth, identify the key businesses that are best placed to benefit from that and dominate their competitors. And so it lends itself to that concentrated investing, and they've been doing that for over 30 years through multiple cycles of growth investing. They're also very strong on the ESG side of things as well. So that's kind of the Sands capital that came in. They're bringing something a bit different with some of these really high trajectory growth companies that we perhaps weren't getting in some other parts of the portfolio, albeit that it was pretty balanced already. And then on the flip side, Metropolis is a bit different, London-based manager, more of a value-oriented manager, but there are lots of managers that are in the world that call themselves value. And indeed, in this portfolio, we've got some a number of managers that we could term value, but they're all a little bit different. And so, Lyrical, for example, is very deep value. They're looking for the cheapest decile of stocks in the market, and then within that finding kind of the diamonds in the rough, the good companies that can grow their earnings and cash flow within that. So Dell as an example of something in that space. And then we got a kind of Vulcan who want more quality compounders, so think Microsoft and Visa and things like that, but buy them when the market volatility gives it to them cheaply. Metropolis is then a bit different still, much more Warren Buffett-like in their thinking. The individuals there have got a private equity background. They're used to actually buying businesses, and so they analyze the companies a bit differently, think quite long-term, quite granular, really going through the financial statements and identifying where the companies have true competitive advantages versus their competitors, and where there's a margin of safety in the business. And so, if you look at a Sands, they might have some things like digital financial services, things like Mercado Libre, Square, Intuit, those kind of companies that are really new technologies enabling broader access to basic financial products. They've got some life sciences innovation in there, the likes of Illumina on genome sequencing and genotyping. You've got Edwards Life Sciences on healthcare equipment and the like. And then they might also have some retail revolution, things like Shopify and Sea and Amazon, those kind of things. Whereas Metropolis, have got a mix of these golden nuggets in muddy waters, as they would call them, like a Berkshire Hathaway or a Cisco. They might have some cyclical market leaders, high quality companies in sectors that are out of favor. So maybe an American Express or a News Corp, that kind of thing. And then unbelievable growth. So high quality growth companies where their assessment of growth is just genuinely different to the market. So Adidas or Visa being examples there. So that's just to give you a feel for what the two new managers have brought in that's perhaps a bit different to some of the other ones that are in the lineup. Maybe worth just touching on how performance has been since the turn of the year. It's actually been very strong. So the trust has outperformed, in NAV terms, has outperformed year to date to the end of August by around 4%. So 19.1% return versus the benchmark of 15.1% return. And that's really, as we've seen the market shift away from just a very small number of companies driving returns to a more broad-based market. We always said that if that kind of market shift happens, then we were excited about what the portfolio would do. So it's very encouraging to see that has been the case, and you have seen that significant outperformance over the first 8 months of the year, which means that we've had decent outperformance since the inception of the new approach. And certainly if you take out the effect of the legacy assets, the private equity and real estate assets that were in there that took a while to sell, then you'd have seen kind of the NAV X those legacy assets up quite considerably, 4% or so since inception. So overall, the performance has been strong as well since last time we talked.
Hi, Craig. It's Dave McFadden. James is offline at present, but I'll pick up on the questions. How do you choose managers, and what is the criteria that you use to assess them?
Yeah. So ultimately, the job is to come in every day and say, is this the best lineup of the world's best bottom-up stock pickers that fit nicely as a single portfolio? So that's what we're coming in with every day. We've got a team of around 80 researchers that just go out and research the various asset managers around the world. So they'll be researching, they'll be doing a few thousand meetings a year with different investment managers, obviously in person back in the day, more virtually in the last 18 months or so. But they are trying to look for a sustainable competitive advantage. So you'll be looking for a thorough understanding of their investment philosophy and approach, evidence that they've stuck to that philosophy and approach, evidence that they are able to really dig into what are the key things that are going to drive the companies they're invested in, hearing why they've got an edge in understanding that relative to the thousands of others managers that we've met, and we'll be challenging them on stock ideas. We'll be sitting with the analysts, going through their stock reviews, challenging them on their valuation of companies. Why do they think they've got a better idea of the trajectory of that company's earnings than the rest of the market? We identify whether they've historically been successful, not just in outperformance, but have they called earnings progression correctly in the companies they've looked at. And so, for example, when a manager's underperformed, we want to understand whether that's because of a lack of skill, or whether that's because they've been unlucky and their style's out of favor. And so, a lot of value managers have struggled until recently, over sort of 2019, 2018. A lot of what we were doing is trying to understand, well, okay, did they actually call the fundamentals of the businesses correctly? i.e. they had the correct view on what was going to happen to the earnings, and it was just that the market was still punishing those on a relative basis compared to a small number of big growth companies in the US? Or was it they actually called the fundamentals wrong? And that's where we're using our judgment to identify who are those truly skilled stock pickers. And then more importantly, recently, we've also integrated a lot of understanding of how strong the managers are on ESG grounds and climate risk in particular.
Right. Okay. Thank you. And how long do you retain a manager when the strategy appears to start underperforming?
Yeah, I mean, this is the hardest question in investment almost. It's the same sort of question as how long do you hold a stock that underperforms. Ultimately, you need to form a judgment on whether anything fundamentally has changed, or indeed whether you think you just got your judgment on the skill of that manager wrong. But all other things being equal, if anything, we're wanting to increase our exposure to a manager that's had a tough time recently. A manager that's got a very good long-term track record. We think they're highly skilled. Nothing's changed at the organization, and they've had a tough time recently. We'd actually be giving more capital to them. Now, obviously, if over a long period of time they've underperformed, that's when you're doing that analysis that I was talking about. How much of that came from their call on the fundamentals of the companies being incorrect versus just their performance looking poor? If they're calling the fundamentals correctly and just the market hasn't yet recognized their style, we would be adding more capital. If they're getting the fundamentals wrong on the companies they're investing in, that would cause you to question whether they're high quality and probably replace that manager.
Sure. And flagging, talking about the mix between growth and value within the portfolio and the managers that you use, how does that overall strategy, how's that performed during the crisis then? Have you found that overall it's given you a solid return during the crisis? Has the pickup in value, for example, been obvious in the value managers within your portfolio?
Yes. So we run the portfolio so that it's pretty style neutral at any point in time, and so we haven't really outperformed or underperformed purely because of value or growth doing well or badly. What's actually impacted the overall performance more than anything has been whether it's been a very tight market driven by a small number of very large companies versus a more dispersed driving of returns. And so that's been a tougher period for us, where you had in 2020 you actually had something like 54% or about 50% of the return on the entire US stock market came from just 5 companies, to put that in perspective. That's a tougher environment for us, where the managers are just picking their best ideas from anywhere in the market. But certainly what you've seen is that the value managers really struggled on average in 2018, 2019 in particular, and have done very well in the last 12 to 18 months. But there's been a bit of a spread in that. The more deep value just focus on the cheapest stocks and then look for good quality companies within it. Those managers have had more extreme underperformance and then outperformance in recent times than some of the managers that are a bit more balanced between their value and growth philosophy.
Mm-hmm. And just another question on that. The question here, can you explain style neutral? What is the beta of the overall portfolio? Is it close to 1?
It is. The beta of the portfolio is pretty close to 1 and is always pretty close to 1. The way we've designed this is to have it such that stock selection drives everything. And, in the very short term, having big country positions, sector positions, style positions can give you very strong relative performance. But over the long term, it really is stock selection that drives everything. And so we make sure that that's what's driving it. And hence, we pretty much neutralize the effect of style in particular on the portfolio. And beta is one of those factors.
Oh, I see. Thank you. How do you decide how to allocate capital to each manager in terms of the amount that's attributed to each manager to manage?
Yes, so we start with a principle of we want to have roughly equal contribution to expected return and risk from each of the managers. And so your naive starting point would be, oh, well, you roughly give them the same amount of capital. But of course, you don't do that because some managers, naturally, their style is a bit more volatile than others. Something that's deep value and small cap, for example, would be much more volatile than large cap quality focused. And so you adjust for it in that sense. So that's your starting point. And then it's looking at how the overall portfolio comes out when you've blended those managers. So we're looking, on an ongoing basis as to is it still true that stock selection is driving everything? Because each manager, when they're running such a concentrated 10 to 20 stock portfolio, will have a strong style bias, will have strong country biases, sector biases, but we don't want that to be dominating risk and return at the total portfolio level. And so that's how we tweak the weights over time.
Right. And how do you therefore overall manage risk for the portfolio on that basis, as you don't control the underlying portfolio specifically?
Yep, so we can control risk in a variety of ways. The most obvious one is that we can just replace a manager at any point, but we also can change the weightings to the managers at any point. So we're on an ongoing basis, we'll be moving around the amount of capital we've got between each of the managers. We don't have to do that a lot because when you've got 10 managers together, you will come out relatively style neutral. And so you need quite a significant drive in markets of, a massive growth run or a massive value run to move that out of kilter, and then we'll make those rebalancing. But it's something we can do at that top portfolio level on a risk control basis. We have access to the portfolio every day. Obviously, we've got the holdings are actually owned in the custodian account owned by Alliance Trust rather than the underlying managers. We're not just investing in their funds, they're running segregated portfolios for us. And so we have access to that analysis on a daily basis and can look at how that's evolving. But it's important that we don't just look at the most traditional measures of risk. We're also looking at other measures of risk, and in particular, some of the ESG risks, as I alluded to. Climate's a big thing for us because we have made a net zero commitment in this portfolio, net zero by 2050 and a halving of emissions by 2030. And the reason for that is that we think that that's a financial decision that will get us better returns and reduced risk with the inevitable move to net zero from something like a third of all asset management capital has signed up to net zero. Put this in perspective. So with that wall of capital moving stock prices, it is important that you're ahead of that that situation. And we've got a team at Willis Towers Watson of 70 climate specialists. All they do is focus on climate. And so we've got a massive advantage relative to others. We've built our own methodology on climate value at risk, company by company, and we can challenge the managers on exactly that, on the stocks they're holding, why they're holding them, change managers where we think they're not strong enough on ESG grounds. And I'm using climate as an example, but it goes much wider than that. And then it's also worth noting that we employ EOS at Federated Hermes on top of all of these managers as one of the largest engagement overlay specialists out there, who are actually doing engagement with the companies on our behalf on a lot of the ESG factors that are considered best in class.
Super. Here's an interesting question on how, the criteria for assessing managers, I guess, because the question is how important past performance is when you assess underlying managers, and therefore whether or not newly established managers with shorter track records are able to add to the party, as it were. Would you consider newer firms?
Absolutely, we do. So, as an example, GQGs in this portfolio, they had been running for less than a year when they came into this portfolio. So we certainly don't have to have a manager that's been around a long time. Bill Canco from Black Creek, he came from another organization. Quite often what it is we identify individuals that have got a strong long-term track record and have shown that they've got the ability to add value through the market cycles, but they might have left other organizations and started up their own firm quite recently, and we are absolutely prepared to follow those individuals and go to those organizations, as long as we've done the appropriate operational due diligence on the new organization and understanding of how the analyst team has been built up around those key individuals, and whether they're going to have the same kind of level of resources that made them successful in their previous organization. But yes, we certainly don't have any rules like this fund has to have had an X year track record that's outperformed by Y. It doesn't work like that at all. It's much more understanding, have these individuals got evidence that they can work through market cycles?
Yeah, absolutely. And a couple of similar questions on turnover. One was on how you have a view, look through turnover of the overall trust, and whether or not you have managers who are running a mix of both high and low turnover strategies within the overall portfolio.
Yeah. So on average, most of the stock pickers are relatively low turnover compared to the average that's out there. And so we are asking managers to think long-term, ignore short-term benchmarks and peer groups, as I said before, and ultimately give us their best long-term stock picks and think about risk in terms of permanent loss of capital. And so the typical turnover that you see from the managers over the long term is in the kind of 20 to 30% type range. So think of that as a sort of 3 to 5 year time horizon on the stocks they're holding. I think the average in the industries about 100% turnover or slightly more. So you can see that they're a bit more long term than average.
Sure.
On top of that, you've then got and so there are no really high frequency traders in this at all. That doesn't really fit in this particular approach. On top of that, there's obviously the turnover of the managers from our perspective, and we said at outset we would expect that to be in the sort of 10 to 15% range. So in other words, we'd be holding managers on average for sort of 7 to 10 years, which would imply that we're changing about one manager a year, something like that. That's exactly what we've had since inception. Now, it happens to have been 2 new managers came in April, but there were a couple of years where there were no changes to the manager lineup at all. So if you actually take it from inception, both the turnover that we've had from changing managers and the turnover of the underlying managers in their stock portfolios has been pretty much what we said it would be from outset. Slightly higher turnover from the managers on the stock side than we said, purely and simply because you've had such extreme movements around the crisis that threw up a lot of potential bargains for managers to take profits on some of the stocks that have done well and buy some things that have been hit quite forcibly in the start of the crisis.
Sure, thank you. And a couple of questions that are fairly similar in what the fund invests in. Obviously, the focus of the trust at present is a pure equity exposure. And one question is that whether or not you would look to have managers who invest in credit, debt, or real estate or commodities. And the other question was whether or not you would consider a fixed income sleeve if interest rates were to rise.
Yeah. So when the board did the review of the trust prior to us taking over in April 2017, they spent a lot of time talking to shareholders and deciding what was the appropriate strategy going forward. And it was felt that going back to the trust roots as a pure global equity portfolio was the right way forward. So it did have some credit exposure, some real estate, some infrastructure, private equity at the time, and it was a considered view to go to 100% equities, and so that is what the trust is going to be. So we wouldn't be considering managers outside of that or instruments outside of that. On the interest rate environment, though, that obviously does impact the kind of stocks that the managers are purchasing, and clearly that is something we spend a lot of time talking to the managers in the lineup as to their views on interest rates and inflation from here, and what implications that has for the kind of companies that they would be holding. And we've clearly, in a period where there's been declining rates for many years, that's been very positive for growth companies. Is that going to be different if we see inflation from here and a pickup in rates? And that's the kind of debate that we're having with managers quite regularly.
Okay, thanks. And there's some questions regarding the approach that you use at Willis Towers Watson, and also flagging obviously the company that Willis Towers Watson has a relationship with Witten as well. So perhaps I wonder if I could ask what the differences are in the arrangement between your approach with your connection to Witten and to Alliance Trust, and if there are any differences to how you approach the two companies.
Yeah, sure. So I mean, I don't work on the Witten account for avoidance of doubt, but Witten take advice from Willis Towers Watson on manager selection, but ultimately Witten run their own portfolio and make the final decisions on what managers go in and the like. With Alliance Trust, we are the manager to it, and so we not only make the decisions on which managers are in the lineup, which ones come in, go out, but also on an ongoing basis are managing the portfolio, managing the risk, managing the risk on multiple metrics, including those ESG metrics that I alluded to, picking groups like EOS on the engagement overlay side, etc. So very different relationship. We are 100% discretionary on the Alliance Trust portfolio, which is very different to the Witten arrangement. I mean, in terms of the differences between the trusts, you can look at those as they're both global equity trusts, but there are some differences in the way it's structured. The 10 to 20 stock portfolio approach is different. The cost is quite different, but ultimately the Alliance Trust is the one where we manage it on a discretionary basis.
And how frequently does the board review your role as the company managing the trust?
So the board have that as a real-time assessment. I mean, we go to all the quarterly board meetings, and they do their assessment of whether we are delivering what they would have expected of us. And so, you know, they can make a decision to get rid of Willis Towers Watson at any time, in the same way that we can change any of the managers at any time. That is completely up to them. So we are regularly reporting to the board on that basis.
Super, thank you. There are a couple more questions. It's getting close to time now, but let's pick up on a couple of bits and pieces. A quick question on fees. What is the typical fee level for the underlying managers? And so what does that mean in terms of when you talk about your fee, is that a complete look through, including the managers, the underlying managers as well?
Yes, so the 0.65% that I alluded to covers everything. So that covers the manager's fees, that covers our fees, that covers all the costs of running the trust, the director fees, the everything else that goes into an OCR, and so that's inclusive of all of that. And that's why I was saying it's a very competitive cost relative to, well, certainly relative to other multi-manager approaches, but actually relative to a number of single manager approaches.
Sure, thank you. And the last question, I think, is on a topic that often comes up regarding repurchasing of shares. Alliance Trust has been quite active in purchasing shares and defending the 5% discount level target. The question is, do you think that might be a death of 1,000 cuts, or is it that you'll be able to work the other side of that and issue as the discount narrows and performance carries on as it is?
Yeah, so I mean, ultimately, buybacks are a board decision rather than ours. But I think it's worth noting that buybacks have reduced quite a lot over the years. Since we took over, the discount came into about 5.25 or something like that when we took over. Hasn't changed a huge amount from that, and that's not really involved a huge amount of buybacks. There isn't a specific formal target that the board have said that they're targeting on the discount, but as you say, it's tended to stay around the 5 or 6% level for the last few years. But yeah, I mean, I think that our view is that if we continue to see strong performance like we've seen, we're likely to see that discount just naturally come in as there are more and more interest in the shares. And the ultimate goal is clearly to get that discount in fully and potentially go to a premium. But we're confident that if we just do the right thing on the investment side, that will just happen naturally.
Super. Craig, thank you very much for your time this morning. We've pretty much run out of time, but it was much appreciated. And thank
you, Dave, for stepping in as well.
That's okay, James. I'll leave it to you again now.
Yeah, we obviously having technical issues my end. I think we've got thunderstorms down the road, and that's what's knocking out the internet. Nevertheless, we will plough on. I will be back next week talking to Robin Parbrook from Schroeder Asia, and then we've got a full lineup for you for the weeks ahead. And I think Dave should speak to himself again, but I think we are about to announce our next conference, aren't we, Dave?
Yes, we are. Our next conference will be in mid-November. Dates to be finalised. It will be our ESG conference along the same lines as last year's. We will focus on 3 sessions: 1 environmental, 1 social, and 1 governance, providing a lineup of managers in each session, focusing on those specific areas. I think you might recall, those who attended last year, that Alliance Trust joined us on the governance section last year. So perhaps we might even get them speaking again at this year's conference.
Great. Thanks very much, Dave. Thank you very much, Craig. Thanks to all the team, actually, who stepped in when everything started to fall apart at my end. And we'll hopefully see you next week. Thanks. Bye-bye.